Most people have money in the stock market right now and have no idea how it works. That is a problem. And Caveman is going to fix it. Caveman did not always understand the stock market. Caveman used to think stock meant a pile of rocks. Caveman was wrong. But Caveman learned. And now Caveman will teach. Number 1, what the stock market even is. Okay, so imagine Caveman has a berry bush. Berry bush is good. Berry bush makes berries. People in the tribe love berries. But Caveman wants the berry bush to grow bigger. He wants more berries. But Caveman does not have enough rocks. Sorry, enough money. To water the bush, to get more dirt, to build a fence around it. So what does Caveman do? Caveman goes to the other people in the tribe and says, "Give Caveman some gold ore. In return, Caveman will give you a small piece of the berry bush. When the bush makes more berries and Caveman sells them, you get a piece of the profit too." That deal, that right there, is a stock. When a real company wants to grow, they do the same thing. Instead of asking the tribe, they asked the public. They cut their company into millions of tiny little pieces called shares. Each share is a tiny piece of ownership in that company. People buy those shares. The company gets the money it needs to grow, and the people who bought shares now own a little piece of that company. According to Charles Schwab, when someone buys a stock, they are purchasing a small ownership stake in that company, which means they may share in its profits and its risks. Caveman nods slowly. Caveman understands. But here is where it gets good. Once those shares exist, people do not just hold on to them forever. They trade them. They buy and sell them. And that is the stock market, the big place where all that buying and selling happens. The New York Stock Exchange, the NYSE, is the biggest one in the United States. The NASDAQ is the second biggest. According to National Bank, the NYSE is the world's largest stock market, home to shares in many major U.S. companies. Caveman looks at Wall Street. Caveman is impressed. Caveman has never seen so many people in ties running around grunting about numbers. Number 2, how a stock gets its price. This is where most people get confused. But Caveman will make it simple. The price of a stock is not just made up. It is not random. It comes from one thing and one thing only. How many people want it versus how many people are selling it. That is it. Supply and demand. Simple as a rock. Say Caveman's berry bush company is doing really well. The berries are amazing. Everyone loves them. Suddenly, a lot of people want to own a piece of that berry bush. They all try to buy shares at the same time. But there are only so many shares available. When more people want to buy than there are shares to sell, the price goes up. Now flip it. Say there is a drought. The berries are dying. People are scared. Everyone wants to sell their piece of the berry bush before it is worth nothing. Too many people are trying to sell at the same time. Not enough buyers. When more people are selling than buying, the price goes down. According to the Motley Fool, stock prices on exchanges are governed by supply and demand. At any given time, there is a maximum price someone is willing to pay for a stock, called the bid price, and a minimum price someone is willing to sell for, called the ask price. Caveman now understands why his rock collection loses value when everyone else also has rocks. But supply and demand is not the only thing that moves stock prices. Other stuff matters too. If a company makes more money than people expected, the stock usually goes up. If a company loses money, the stock usually goes down. If the whole economy is struggling, like when inflation is high or interest rates go up, many stocks can drop at the same time. According to the Motley Fool, a market can fall due to things like inflation pressure, supply chain problems, rising interest rates, and recession fears. Caveman does not fully understand interest rates yet, but Caveman is learning, one step at a time. Number 3, what bulls and bears actually mean. Caveman sees these animals on the news a lot. People keep saying bull market And bear market. Caveman thought they were talking about the zoo. They are not talking about the zoo. A bull market is when stock prices are going up over a period of time. Things are good. People are buying. The economy feels strong. Everyone is kind of happy and confident. A bear market is when stock prices are going down, usually dropping 20% or more from their recent high. Over a period of time, things feel bad. People are scared. They are selling. Nobody wants to buy. Why a bull and a bear? The idea is that a bull attacks by pushing its horns up. A bear attacks by swiping its claws down. So a bull market pushes prices up. A bear market drags prices down. Caveman prefers neither animal. Caveman has been chased by both. Here is the important thing to know. According to NerdWallet, bull markets tend to last longer than bear markets. Over time, the stock market has trended upward. The S&P 500, which tracks about 500 of the largest U.S. companies, has historically returned an average of about 7% annually, when accounting for reinvested dividends and adjusting for inflation. That means if Caveman had put 1,000 gold ores in the market 30 years ago, Caveman could potentially have around 7,600 gold ores today. Caveman's jaw drops. Caveman wishes he had started sooner. Number 4. What an index is. Caveman cannot watch every single company all day. There are thousands of them. Caveman does not have that kind of time. Caveman has berries to pick. So people made a shortcut. They grouped a bunch of important companies together into one number. That number is called an index. When someone on the news says, "The market went up today," they are almost always talking about one of these indexes. The 3 biggest ones in the US are the S&P 500, which tracks about 500 of the largest US companies and is the most watched one. When most people say the market, this is what they mean. The Dow Jones Industrial Average, or the Dow, which tracks 30 major US companies like Apple, Microsoft, and Nike, and the NASDAQ Composite, which is heavy on technology companies like Apple, Google, and Amazon. These indexes go up and down every single day. They are like a temperature reading for the whole market. One number, easy to look at, easy to understand. Caveman likes this. Caveman does not have to check 500 stocks. Caveman just checks one number. But, and this is important, just because the index goes down on one day does not mean everything is falling apart. Markets go up and down all the time. That is normal. That is how this whole thing works. Caveman panics sometimes too, but Caveman is working on that. Number 5. How to actually buy a stock. Okay, so Caveman wants in. Caveman wants to own a piece of something. What does Caveman do? First, Caveman needs a broker. A broker is just someone, or more likely an app or a website today, that is licensed to buy and sell stocks on behalf of someone else. Think of it like a middleman between Caveman and the stock exchange. In the old days, this was an actual human being sitting at a desk. Someone would call them on the phone and say, "Buy me 10 shares of that company." The broker would go make it happen. Today, most people use online brokers. Companies like Charles Schwab, Fidelity, or Robinhood. Caveman opens an account, puts some money in, and can start buying shares in a few clicks. Here's how the Motley Fool explains what happens when someone buys a stock. The investor tells the broker what stock they want and how many shares. The broker sends that order to the exchange. A market maker sells the shares at the current price, and the shares land in the investor's account. Simple! Like trading a rock for a berry. Just more steps, and more screens, and a lot more numbers. Once Caveman owns shares, there are 2 ways to make money from them. The first way is if the stock price goes up. Caveman buys 1 share for 10 gold ores. The company does great. Now that share is worth 20 gold ores. Caveman sells it. Caveman made 10 gold ores. That gain is called a capital gain. Note, taxes may apply on that profit, so it is worth understanding the tax rules in your area. The second way is dividends. Some companies pay their shareholders a little bit of money regularly, just for owning the stock. According to Charles Schwab, well-established companies often pay out some of their earnings to shareholders through dividends. If the annual dividend is $3 and someone owns 50 shares, that is $150 a year just for holding the stock. No selling required. Caveman likes the second way. Caveman likes getting gold ores while doing nothing. Caveman is learning the way of passive income. Number 6. Why stock prices sometimes do weird things. Caveman has noticed something strange. Sometimes a company seems to be doing fine, but the stock drops. Sometimes a company has problems, but the stock goes up. Why? Because the stock market does not just react to what is happening now. It reacts to what people think is going to happen in the future. If investors believe a company is going to do amazing things next year, even if things are just okay right now, the stock price can go up today. Because everyone is buying it in advance. If investors believe a company is going to struggle in the future, even if things are fine right now, the stock price can drop today. Because everyone is selling before the bad times hit. This is called market sentiment, and it is very powerful. According to VectorVest, when financial analysts push a pessimistic viewpoint to the masses, even without strongly negative economic conditions, it can result in a negative investor sentiment taking hold, and the market can drop, not because the economy is actually falling apart, but because enough people believed it would. Caveman has seen this in the tribe before. One person says, there are no more berries, and suddenly everyone panics and trades away their berry shares. Even though the berry bush is fine. Psychology is a big part of the stock market. Humans run on feelings. Caveman knows this very well. Wikipedia also notes that the stock market sometimes reacts in ways that seem strange. Even to economic news that probably should not affect stock prices much at all. The market is not always rational. Caveman is comforted by this. Even the smartest investors get confused sometimes. Number 7. The difference between investing and trading. There are two kinds of people in the stock market. Investors and traders. They are not the same thing. A trader tries to make money quickly. They buy stocks and sell them fast, sometimes in the same day. They are watching charts all day. They are trying to catch every little move up or down. This is called day trading. Day trading is very hard. Most people who try it lose money. It takes a lot of time, a lot of skill, and a lot of emotional control. Caveman does not recommend this for beginners. An investor takes the long view. They buy shares and hold them, sometimes for years. They are not worried about what happens today or this week. They believe that over a long period of time, the companies they picked will grow, and the value of their shares will go up. According to NerdWallet, even with all the ups and downs, the S&P 500 has historically trended upward over time, which is why long-term investing has worked well for many people. Famous investor Warren Buffett, one of the most successful investors in history, has said the key to investing is to understand the company, invest in solid things, and focus on the long term. According to National Bank, Buffett favors relatively simple rules. Understand what you are investing in, invest in stable values, and stay focused on the long game. Caveman respects this deeply. Caveman is also a big fan of the long game. Caveman has survived many winters by not panicking. Number 8, the risks. Because there are risks. Caveman must be honest now. The stock market is not free money. It is not a magic gold ore machine. There are real risks. When someone buys a stock, they can lose money. If the price drops and they sell, they walk away with less than they put in. If a company goes out of business, the stock can become worth nothing at all. According to Wheelhouse Advisory Group, individual stock investing can carry a high amount of risk. It takes careful thought. A company might struggle, or it might simply do worse than the broader market. This is why many financial experts suggest that instead of picking individual stocks, beginners look at something called an ETF, an exchange-traded fund. An ETF holds a basket of many different stocks at once. So instead of owning just one company, the investor owns a little piece of many companies at the same time. According to Charles Schwab, ETFs share characteristics of an index fund and a stock. They can be traded like a regular stock, but they spread risk across many companies. Caveman understands diversification. Caveman does not put all berries in one basket. Caveman learned this the hard way, when the wolf ate the basket. The point is, always understand what is being invested in. Never put in money that cannot be afforded to lose. And if this feels overwhelming, talking to a real financial advisor is always a smart move. Caveman is not a financial advisor. Caveman is just a caveman who did a lot of research. So in one place, a stock is a tiny piece of ownership in a company. The stock market is where those pieces get bought and sold. Prices move based on supply and demand, company performance, and how people feel about the future. Indexes like the S&P 500 track how the whole market is doing. Anyone can participate through a broker, and the best results tend to come from long-term thinking, not short-term panic. Caveman started with zero understanding of any of this. Now Caveman understands a lot. The stock market is not as scary as it looks. It is just a very big, very loud trading post, with a lot of people in suits. Caveman prefers furs, but Caveman will adapt. With that said, I'll see you on the next video.